What's up, YouTube? This is Davian here with Light to the Wealth Academy, and today we're going to be going over the Federal Reserve and what the head of the Federal Reserve, Jerome Powell, has listed today. Today was a meeting with the Federal Reserve, and the press conference was a press conference for July, and a couple of things happened today. So we're going to break this down, and we're going to go over it step by step, okay? First thing I want to show you is this right here, the federalreserve.gov website. This is the meeting that happened today, and we're going to go over a little bit. We're going to listen to some of it. And here it says, he does a little press conference in the beginning, talking for about most of the thing, and then it's just kind of questions towards the end. So we're going to listen to him speak for a little bit, and then we're going to go into some of the questions that he did at the end. Most of them were recession-based questions. There was a 75 rate hike today, so the interest rates are going to go up by 75 basic points. For those of you who don't know what it means, interest rates have been at zero for probably since 2008. Since the last recession, interest rates have been at zero. They raised interest rates to combat inflation. We're seeing high inflation right now, so the only tool in their arsenal is to raise interest rates a little bit so that they make money more expensive to get and they kind of combat and bring down inflation. But let's let Jerome Powell speak and get back with you in a second.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
So when he said 0.75 basic point, 1 basic point would be 100. So he's 0.75 of 75. That's why he said that.
In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
So removing the balance sheet over the last 2-3 years since the beginning of the coronavirus and the pandemic, the Federal Reserve started doing purchasing of assets, and they were adding that to the balance sheet. The reason why the stock market had a booming like after COVID hit was because the Federal Reserve, the people who make money for the country that we live in, were buying the stocks, buying the bonds, and buying all the assets up themselves and putting it on their own balance sheet. Since the beginning of this year, the Federal Reserve has been liquidating their balance sheets. They've been removing $90 billion worth of assets that have been sitting on their balance sheets off of the balance sheets. So he's just saying that they're going to continue that process. This is not really anything new. They said this in the beginning of the year. They said it was going to continue. So it's just them saying that they're going to continue that same process.
Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months,
he says wage growth has elevated, but inflation has far outpaced the growth of wage growth. We have 9% inflation. Just look at your personal salary. Has your company given you a 9% raise? If not, then you're not combating inflation. You're actually making less money than you did last year. For the housing market slowing down, when the Federal Reserve raised interest rates, it makes mortgages more expensive. If you had a $500,000 house in 2020 at a 3% interest rate, your mortgage rate would be around $2,100. Pretty easy to afford, most people. today, as interest rates are at 5.7% and they're going to go up tomorrow, so it should be around 6%, the same mortgage for a $500,000 house would cost you $3,000 a month. That's why housing is going to start slowing down, why the market is going to start feeling it back, and then why housing prices should eventually drop. But right now we're at the very start of it. We're very far from that process. It's going to take another 12 to 18 months before the housing market even starts to catch up. It starts to fall down back to normal levels. And we also have a couple of things to watch out for on the inflationary period as that happens.
Employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure.
All right, we're going to pause it right there just because of what he said. Gas prices were rising before Russia invaded Ukraine. Across the board, gas prices were rising before Russia invaded Ukraine. What Joe Biden did when he wanted to cut Russia out of the world economy was he took one of the countries who produce the most oil in the world and told them you can't sell oil anymore to Europe, to most of Asia. They try to cut them out of the system. Russia's economy is doing fantastic. I just want to put this out. So we're raising basic points today. Russia, this week. Russia's central bank cuts interest rates as inflation eases. Russia's inflation is going down right now, while the United States inflation is going up. So it's not a Putin price hike that Joe Biden keeps repeating and that Jerome Powell wants to spin off to. That's not what's causing the prices of gas to go up. What's causing the price of gas to go up is Joe Biden cutting the Keystone Pipeline, cutting contracts in Alaska, cutting contracts in the Gulf of Mexico. All the contracts that he's cutting, not allowing oil producers to produce oil, is what's making gas prices go up.
On inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, That is a decision that will depend on the data we get between now and then.
So what he's currently saying is that they may be considering raising interest rates by 100 basis points, maybe just doing a whole 100. So right now he said we're at 2.5. He's like, we can go to 3.5 instead of going to a 50-point basic hike from 2.5 would be to 3%. 75 would be to 3.25. If we do 100, that'd be 3.5. So he's saying that if the economy keeps going the way it is, and he's saying that there's positives coming out of it. CPI numbers came out at 9%. Even though if you look at everything on that list, everything was up in the double digits. He's saying that they are looking at possibly doing 100% basic points. Wouldn't really be that good for the economy. Wouldn't be good for the stock market. Wouldn't be good for your personal finances. Wouldn't be good for inflation. It would be good for inflation because it would combat inflation and help bring inflation down. But it would be at the expense of you and me, expense of our finances being more expensive.
We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Rachel. Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 2.25 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5, and then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. And we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations, and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jarrell. Thanks for taking our question. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
All right, so this is the hypotheticals. I want to go towards the end.
Steve Leisman.
Recession.
That it makes you really question the
That's what I
GDP
wanna go
data.
towards.
Rate of unemployment might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6.
Violent downturn and the big switch is low by the overtight labor markets
I'll go towards the end.
is to bring inflation down and have a so-called soft landing, by which I mean
Rapid monetary.
Okay, go back. Here we go. Sorry. This guy.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. From a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been.
How do you guys feel? Do you guys feel like you're in a strong financial state right now? Leave a comment down below. Let me know if you think you're in a good financial state. Better than last year or the year before.
In a very long time, or perhaps ever, given what the money that's on people's balance sheets. And so you have a pretty, from a financial stability standpoint.
All right, I'm done with this guy. But yeah, I'll put a link to the video if you want to watch the whole thing. It's about an hour long. I don't want this video to be too long. You can go watch it. It's right on the Federal Reserve website. It's the first video right here. Besides that, just wanted to let you guys know that pretty much the big takeaways today. Jerome Powell says we're not in a recession, but we're heading towards a recession. But we could very possibly be heading towards a recession. The housing numbers come out tomorrow, so we're gonna look at those numbers and see how they actually reflect to the real economy. We have a 75-point basic hike. So interest rates are going up today. Houses are going to become more expensive. Cars are going to be more expensive. Food's going to become more expensive. Everything's going to become more expensive just because of this. And yeah, that's pretty much it. Besides that, please like, subscribe, leave a comment down below. Let me know what you think about this video. If you like it, want to see more content like this, I'll produce more like this. Besides that, thank you to all of you who watched this, and have a great day.